Hey everyone, welcome back to the channel. If you saw my video a couple days ago, you'll know that Equity Commonwealth, which is one of Sam Zell's REITs, it announced that it is acquiring Monmouth Real Estate, which is another REIT, and it's an industrial portfolio, which is very different than the really right now cash and office portfolio that Equity Commonwealth has. I want to actually do a deeper breakdown of this actual deal and the portfolio, what Equity Commonwealth's actually getting into, whether this deal seems good on its face. Just want to go through all the details there to better understand this, as I am a shareholder of Equity Commonwealth and I want to see what I'm getting myself into and whether maybe I should double down on my position or trim back or whatever. And it goes without saying that none of this is financial advice, since you have to do your own research and understand your own risk tolerance, since every person is different. But anyways, let's get into it. As you can see, the big announcement was a couple days ago on May 4th, Equity Commonwealth to acquire Monmouth Real Estate for $3.4 billion. But that's a little bit misleading, since that makes it sound like it's a cash deal. It's actually an all-stock deal, and I'll explain how that's structured in a bit. But anyways, what's Equity Commonwealth? For someone who might be new to Sam Zell, new to this REIT, if you haven't heard of it, if you haven't seen the other content I have on it on this channel, Equity Commonwealth is a REIT owned by Sam Zell. He's a billionaire real estate investor with a very long track record of success in the real estate industry specifically. And this was a REIT that he acquired in 2014. And they ended up selling off hundreds of office properties that were in this portfolio that they acquired with Equity Commonwealth. So now they're sitting on this huge cash pile of $3 billion and just 4 properties. So it's been this transformation, almost turning it into like a sort of real estate SPAC, if you want to call it that, where they have this big cash vehicle ready to invest in another venture. And he's been searching for deals for quite some time. Sam Zell is definitely an opportunist who looks for distressed deals most often, tries to get things that are below replacement cost, which is a little unusual when you take this deal into account, since it's not really one that might be deemed distressed. Definitely not distressed, and probably not below replacement cost, but we'll get into the numbers in a bit. Here's Equity Commonwealth's portfolio right now. It's 4 Class A office buildings, and that's across 3 cities, that being Washington, D.C., Austin, and Denver. But this is very little compared to the amount of cash they have there. And this gets into the valuation portion. This will be very important for later, too, for understanding how commercial real estate is valued. Because how do we value this portfolio? Well, with any commercial real estate property, this is typically how it is. This is the way you get a ballpark valuation. You take the net operating income, which is sort of like a profit number, but this is the amount of income before you pay your debt. But you're paying all your other expenses, management, capital expenditures, all that stuff, that's caked into NOI. However, your debt is not, since you're trying to get the value of the property, and if you have a really great loan term, for example, that's not really going to necessarily transfer to the next guy who wants to buy the property. So it's not factored into this equation. Down here you have cap rate. This is a semi-subjective measure, but if you do some algebra, you'll see that cap rate equals net operating income divided by sales. If you just do that basic algebra there, that's what cap rate is, but it's generally a subjective measure for how you actually value an income stream in a given market, in a given class of buildings. It's a tool for pricing and given NOI stream. So if you have a Class A office building compared to a Class B or C office building, the Class A one is going to have a lower cap rate. It's comparatively lower risk, or theoretically at least. It depends on each building, of course, but generally speaking, a Class A building is going to be lower risk. Maybe it's in a stronger market, might have more prospects for growth and appreciation in the future, as opposed to a B or C class building, which might have less of that. So investors are going to demand a much higher cap rate for higher risk properties, or properties that have maybe less prospects for growth in the future. That's typically how it works. That's very generalized, and every building's going to be different because real estate's unique in that way. Every property is kind of its own little thing, but you're comparing it to properties of a similar class in a similar market to come up with this pricing tool. So you divide NOI divided by cap rate to get your sales price, and that's the general value of the building. So it's based on the income of the building primarily. If you can boost income, cap rate's staying the same, then your sales price is going to go up. So income, very important for valuing an actual commercial real estate property. That's different from the straight up comps approach that you'll find with single family homes in the US, for example, where it's based on what your neighbor sold for, whose house looks similar to yours. It's not really about the income that it can actually produce. Applying this to Equity Commonwealth, I did a more detailed breakdown on this long ago when I actually initially invested into Equity Commonwealth. I also did it over on Brad Kellner's channel, so definitely check that out. I'll link it below if you're curious. shares. It is a little bit old by now, but the portfolio hasn't really changed. So here's what's going on with that valuation. You have the NOI of about $40 million per year. That's based on numbers from a couple quarters ago. I actually haven't checked if that's changed very much, since even if it changes quite a bit, it's not really going to move the needle on the size of the portfolio because of where the cash hoard is. That's kind of the primary value of the Equity Commonwealth portfolio, at least prior to this next merger that they're trying to do. But anyways, you have about a $40 million NOI divided by about a 6% cap rate was based on the metrics that you're seeing nationwide with Class A office. There hasn't been a lot of transactions, so it's kind of hard to figure it out exactly, but we'll say ballpark 6%. That would mean that the portfolio is worth around almost $700 million. I'll say $600 million. Depends on where you move that cap rate. If you push it up because you're bearish on office, that's going to make this price go down. If you think office is here to stay, Class A office is great, this is totally underpricing it, then you would move that cap rate down, maybe 5%. That would be very bullish in my opinion. So we'll just say $600 million or so for the Equity Commonwealth portfolio value. That's just the 4 buildings. What about the flip side here? Monmouth Real Estate. They have a much larger portfolio of properties, 120 properties to be exact, and they're all industrial properties, net leased to grade A tenants. So in a similar way to Equity Commonwealth, they go for higher grade tenants, or at least it's a higher grade sort of building that they're renting out to a higher grade tenant. But it's industrial, so it's a different ball game than office, that's for sure. But it's 99% occupied, so can't really say there's a lot of distress there, and they're collecting rents without really any issue. And industrial's been on a big run up. Get into that in a bit too. But here's the portfolio footprint. You can see they're all over the place. And a lot of these pictures and graphs you'll be seeing come from either Equity Commonwealth's site or mostly from Monmouth's investor relations site, and also any investor reports or filings that they've made. That's where I'm pulling a lot of these excerpts and everything from. But you can see geographically pretty diverse, but definitely leaning towards the East Coast. And they say that most of the population is east of the Mississippi River here, which is in the middle of the country, or I guess it's a little bit to the east of the country because the US is a very big place. And they are continuing to expand, or at least they are prior to this merger. That's what they were doing. They were expanding their industrial portfolio. But here's a very high level overview of the deal. This is going to be pulling some quotes from the actual announcement that was made a couple days ago that I broke down a few days ago. So definitely check out that if you're interested in seeing what Sam Zell had to say about it explicitly. I gave my commentary on it as well if you wanted to see my initial reaction on the deal, and also what some of the shareholders on the earnings call were thinking about the deal as well, since they made their announcement not too long ago. But it's an all-stock transaction, which means that Equity Commonwealth's cash pile is preserved. It's dry powder, as Sam Zell called it. He really thought that was very important. He's all about liquidity. That's been a big theme of his investment career. He wants to keep that dry powder ready to go. So if a better deal or a different deal comes up, he can pounce on it. Since I don't think this is the home run deal he's really looking for, this is almost like a sort of transition deal as he tries to shift the business a little bit, but he's really waiting for that home run distress deal, I think, in the future. He hasn't said that, but I think that's really what this deal's all about. But again, we'll get to that. Trying to get through some of the numbers first. But they're acquiring a top quality industrial portfolio, and Zell said that it has strong fundamental tailwinds, the industrial sector, which, I mean, they've already been on a big upswing, and I guess he sees there being more of an upswing in the future, since I guess it's hard to argue against that, seeing as retail is declining, industrial often is taking its place as the sort of new store. You'll see some interesting pictures as part of the Monmouth portfolio in a second. But the industrial sector is crowded, but not too crowded. That's what Zell said on the call a couple days ago. So he recognizes that people are flooding into the industrial sector because they just can't get enough of it. You got a lot of great tenants, and everyone seems to be paying. It seems to be one of the few sectors that hasn't really been hit too hard, at least from the warehousing and distribution sector within industrial. Of course, manufacturing hasn't necessarily done as great compared to maybe decades prior, but certainly anything having to do with e-commerce and that sort of distribution side of the business has been doing fantastic. And that's definitely driven a lot of the price appreciation that you've seen in the industrial sector. But anyways, they're trying to become a leading industrial real estate company. That's the goal with this transaction, according to the Equity Commonwealth board. I'm not going to read all this verbatim, but this is a very important section, or two important sections of the merger agreement, since it's very important to see if you're an Equity Commonwealth shareholder, what are they doing with these shares, since this is a stock for stock transaction, essentially. So sure, they're not giving up cash, but they're giving up something, and that's actual value in Equity Commonwealth. But you can see here that for every common Monmouth share, that share is going to get 0.67 shares of Equity Commonwealth. So the Monmouth shares will eventually dissolve and be replaced with a smaller fraction of Equity Commonwealth shares. So Monmouth shareholders will get a cut in the Equity Commonwealth business in the merger, which makes sense. They're surrendering their company essentially, and they got to get something in return. The two are becoming one. But also, that's not it. That's not the only share compensation we're getting here. You can see that Monmouth has these preferred shares, and each one of those shares will receive $25. I think there's about 20 to 30 million of those shares out there. And yeah, as we can see here, there's 98 million company common shares that were issued and outstanding as of May 4th. And then there was 21 million company preferred shares that were issued and outstanding as of May 4th. So that's what we're really dealing with here. And that's what determines what Equity Commonwealth's actually going to have to pay with their actual share compensation, the 0.67 and then the $25 per share for the preferred shares. Which, if we go to my little summary here that I put together, here's kind of what Equity Commonwealth will look like before the deal and then after the deal. At a very high level, this isn't gospel by any means, but this is just kind of getting a ballpark, seeing what this shift in the company will look like. So pre-deal, we've got $3 billion in cash and approximately a $600 million portfolio of 4 office properties, which should mean that Equity Commonwealth prior to the merger is worth something like $3.6 billion. Again, ballpark, depends on how you value things as well. So this is just my subjective valuation. Could be wrong, of course, and beauty's in the eye of the beholder, of course. So we'll just say $3.6 billion as a ballpark estimate for what it's worth, but it's going to be changing since they're going to be incorporating not only the properties, the 120 industrial properties, but also $1 billion in debt on the Monmouth balance sheet. And the press release said that the new company, once they're put together, be under Equity Commonwealth's name, would be worth about $5.5 billion. But of course, they're not just gaining $2 billion in value, they're paying up with shares, as I note here at the bottom. Monmouth common shareholders receive 0.67 EQC shares per MNR share that they have, worth approximately, if you're using today's numbers, about $1.9 billion. But I'm not sure if that is locked to the May 4th price or whether it's actually going to be at the actual closing. I need to clarify that, but it shouldn't change too much theoretically, since it should be a relatively equal value. It's not as though one side is getting a huge premium over the other one, but there definitely is a premium in this deal, it seems. And preferred shareholders will receive about $550 million in shares, or the $25 per share, for a cumulative total of around $2.6 billion in stock paid by Equity Commonwealth. So that's what this deal is looking like, which would mean if you did 5.5 minus 2.6, that would make it seem like there's a few $100 million in premium. But I think that $5.5 billion value that was advertised in the press release might be underselling what the actual industrial portfolio might be worth right now, since cap rates have just gotten so low because industrial's so hot right now. Very valuable properties to have under your belt if you can get them at a decent price, of course. But anyways, that's assuming if we take their numbers for what they're worth, 5.5 billion is what they're estimating. I think it might be closer to 6 billion based on the industrial cap rates that we're seeing, but we'll just go with this. But anyways, let's get into the actual details of Monmouth itself, since that is what Equity Commonwealth is absorbing. It's the Monmouth portfolio, including their debt here, which is the big thing I wanted to highlight. They got $1 billion in debt or so, and most of this is longer-term debt. Granted, in the commercial real estate space, it's not as though you're getting fixed-rate 30-year mortgages like you might get with a single-family home. Often, it's something like a 5-year term, usually with a balloon payment at the end of 5 years, or it's somehow adjustable after 5 years. It's typically how it works, and it might be on a 25-year amortization schedule, so you're making payments as though the loan lasts 25 years, but then there's this big balloon payment where the loan is called and all your balance is called at the end of 5 years, which means that unless you have a ton of cash, which maybe Equity Commonwealth's cash will be used to pay some of this debt down. What that really means is that every 5 years, or however many years the term is, you're getting a refinance and you're getting a new loan that locks in your rate for a few more years after that. That's typically what happens. So you get a lot of rollover with these commercial loans that have relatively short terms compared to the thing that you might be used to in real estate with the 30-year fixed rate mortgages. In the commercial space, it is definitely different. And this chart shows that about 15% of the loans are due in the next 2 years. So I'd imagine they're either going to be refinancing those or maybe throwing some Equity Commonwealth cash onto it to pay down this debt. It's hard to say what they're exactly going to do. They haven't said they would do that, and I'm not sure if they're going to be selling any of the assets in the Monmouth portfolio. That seems to be a pretty likely thing that might happen, in my opinion, but again, we'll see. They haven't said either way. But anyways, industrial real estate. What is driving industrial real estate? Why is it attractive? Why would any investor want to get into it right now? This is something that Monmouth's pointed out in their investment presentation, and I think it hits the nail on the head. See, e-commerce sales have been growing like mad over the last decade, and they're continuing to grow, especially with the lockdowns. That was a big catalyst for e-commerce, and certainly I don't want to say nail in the coffin, but a very negative catalyst for retail, which has been suffering. And it's not as though people are spending less. Americans have spent more than ever in the last year compared to before, and they're spending it on things like e-commerce. They're not necessarily going to a mall to make those purchases. There still certainly is plenty of mall sales, but not nearly to the level as it was before, and e-commerce seems to be stepping in the shoes to fill that consumer demand. This bodes well for industrial real estate, especially in the distribution side, since you got to move that stuff around, you got to store that stuff somewhere. It's just not at a storefront anymore. Instead, it's at larger warehouses. And that's illustrated very nicely by this example, which is actually a property that Monmouth owns. This is the Big Town Mall, was for many years the largest mall in Texas, and this is many years ago. It's now been turned into this FedEx distribution facility, which is one that Monmouth owns, 352,000 square feet. So this massive complex that's just used for distribution. That's what's replacing retail in a lot of cases. Not replacing all retail by any means, but it's replacing the large chunks that are being lost in retail. And there's other things that industrial encompasses as well, but this is a huge part of the portfolio. It's this sort of distribution center style industrial property, mainly FedEx being a massive tenant for the Monmouth portfolio. But it's just kind of wild to see that a mall has literally turned into a e-commerce FedEx distribution center. FedEx does more than e-commerce, of course. They're doing business mail, lots of things, but FedEx is a big shipping company and you ship stuff. So the stuff used to maybe be in a mall. Now it is in this distribution center, shipped right to your door. And you got a bunch of these properties in the portfolio, these single tenant net lease buildings. Net lease meaning that the tenant is paying for the vast majority of the expenses. They are the ones taking care of taxes and that sort of stuff. That's typically what a net lease means. There's some flexibility in what it can mean, but the tenant is paying the expenses, predominantly speaking, which should limit the variability on the expenses that a portfolio manager would actually have to pay. So that is a plus, but you're paying that as a premium when you buy an industrial property generally. And here's more on the surge in industrial. Saw that dip with the 2008 recession, of course, but everything in real estate pretty much dipped. That was more of a debt problem, I would say. And also you had demand issues as well, since lots of people lost jobs, and wasn't necessarily as much helicopter money as there's been going around in the last year. So people are still spending a lot of money, and industrial cap rates have really compressed because of that. And again, when cap rates compress, that means that prices go up for the same level of income. Because remember that formula, NOI divided by cap rate equals sales price. And the cap rate is a decimal, so it's going to make that number bigger when it goes down. So U.S. industrial cap rates are down to a measly 4.1% on average, which is really just kind of nuts. You are either factoring in the fact that there's practically no risk, or of course there's risk in any investment, but relatively little risk compared to maybe other buildings, or you're factoring in a lot of growth in the future, just like you would when you're paying for any sort of investment. If your cap rate right now is that low, that typically means that you're expecting more in the future, or it's going to be a really rock solid asset. So either could be the case, but they are certainly very low, historically low levels for industrial and really for many types of real estate. And it makes sense that occupancy has remained very high and is well over 95%, and that's despite all the new construction that's coming online. But again, a lot of people are going into the space, so there could be an oversupply at some point. Sam Zell will be keen on that, and that might be why you'd have a hair trigger to sell some of these assets, I would guess. But what about a ballpark valuation for Monmouth? What is their portfolio actually worth? We know what they got going on. They got really high occupancy. That's great. Well, here is something from their recent earnings reports. They say their NOI was $36.5 million for the quarter, which if you multiply that by 4 quarters, get $146 million in annual NOI. That's the important number that we're going to use as that numerator in that equation. So 146 million divided by a 4.1 cap rate, which is the one they use for the national rates. That would mean that the portfolio is worth something like $3.6 billion before you subtract any debt. And if you think that cap rates are going to continue to compress, then you would see at a 3.5 cap rate, it would be about a $4.2 billion valuation. And if you're a little bit more conservative, despite the frothy environment we're in with industrial, that would be $146 million divided by a 5% cap rate. That would mean that the portfolio is worth $2.9 billion. So we'll just say ballpark somewhere between 2.9 to 4.2. Probably at today's cap rates, about $3.6 billion is the portfolio valuation for the 120 properties that Monmouth has and that EQC will be acquiring through this merger. But this is subjective. I'm not saying that this is in fact what the portfolio is worth. Just trying to get a ballpark estimation on what Equity Commonwealth's getting into. Could be much lower than this value-wise. Could be higher, I guess, as well if someone really wants to pay a premium on this portfolio. But like I mentioned earlier, rent collections are very stellar. They have a very great group of tenants, FedEx being a huge one. I'll show you the exact breakdown of what their tenants are in a second. But even through the pandemic and all that turmoil, they were nearly 100% on rent collections, which is phenomenal. Good luck finding that in just about any sector of real estate. And this is probably one of the only ones where you're actually going to get that, at least through that hard time in the pandemic. Industrial really benefited, at least this group of tenants that they have. And you can see some of their high quality tenants, as they say. They are grade A, investment grade tenants is a big selling point of this portfolio. But half of it is in FedEx. That's this green section right here. Half of their rent comes from FedEx, which is a lot of risk in one specific tenant. FedEx, something happens to them, something's happening to this portfolio too. You can see it's not a very diversified portfolio of tenants, even though they are very good quality. You're just putting a lot of your eggs in one basket, which has worked very well in the recent past, but that's something that on the call from a couple days ago, they want to diversify either by growing the portfolio and adding different tenants or selling off potential assets with FedEx tenants in it, perhaps. That would seem to be, I think, the most likely route here in this environment where it's definitely a seller's market. But having just bought the property, they would have to get more than what they paid for it, obviously, unless they really value having that cash. They being Sam Zell, really. If he really values turning this into more cash, then I guess you could do that, but it seems kind of weird to pay a hefty premium on cash since they're paying a premium when they actually bought this portfolio, unless they're valuing it at a very huge valuation that I'm not seeing. But all in all, definitely high quality tenants, but over half of the rent is coming from one specific company. But thankfully, that one specific company, FedEx, has seen increasing volumes in daily packages, and they've had a phenomenal 2021. They keep growing very rapidly, and that should help, at least for the short to medium term, maybe for the long term as well, if they can keep it going. Definitely for the long term if they can keep it going, since that would make that tenant even stronger. And it's a huge portion of the portfolio, so you definitely kind of need it to do well, at least well enough to maintain those rental payments. Here's some of their more recent tenant acquisitions. You got Amazon, you got more FedEx. It's grade A, investment grade tenants, really solid. They're going to pay, at least you would think, as long as the going keeps going good for them, they have a much higher likelihood of making the rent payments than maybe a lower quality tenant would. And we saw that geographic map, but they're not really tied to any one state, which is nice since there is a lot of state law risk with real estate specifically, since you can't move the building. You can move a company in many cases, and sure, it might be expensive to move a company. You cannot really move a building. That is the whole business. You're owning the location, so it'd be hard to move. So it's nice to see that they have some diversity there, even though it is mostly on the eastern half of the US. It's across many different jurisdictions, which should help out for some diversity in the protection of their fairly large portfolio. But what about value add opportunities? Well, that's where the lease expirations would come in. If rents are really low right now compared to what you could be getting because industrial's so hot, there's not enough supply at the moment. Theoretically, there's enough demand to make up for it. You could see that all of these lease expirations could be a way to boost rents in the short term. But you got some in 2021 coming online and then also 2022, so you could boost rents there theoretically. That could be a short-term way to increase valuations, but I bet that's kind of caked into this price that Equity Commonwealth is paying, so I don't think they're getting a huge discount on this portfolio. It would be hard to sell this portfolio at a discount since it's clicking on all cylinders, it seems like, even if you got that tenant risk with FedEx. This note here at the top says that their weighted average rent per occupied square foot is $6.52, which is 24 cents under the national average that they cite here of $6.76, which is something like 3.5% to 4% lower than what the national average would be. So you'd think that they could boost it up to that average, but when you're working with grade A tenants, you might think, oh yeah, I can charge more rent for them, but no, that's part of the risk that you're taking with a Class A tenant. They have leverage too. They're a great tenant, so they're going to get generally a cut on rent. They're not going to be paying over market rents since they're such a quality tenant, at least that's the thinking. paying. Higher credit tenants are typically not going to pay as high of rents. That's part of risk reward. The risk is lower of default for a great company, so they're typically going to get a better deal on rent. So I don't know how much more you could really raise the rent now, unless you get some more appreciation over the next couple of years, which you could easily do. So we'll see what happens there. But if they can raise rents a little bit, you have these expiration dates coming up. That's when you'd be able to do it much more easily if you could do it at all. So that's the portfolio breakdown. What to make of this? Well, it seems like a very strange deal for a guy like Sam Zell. This is a very strong, high quality portfolio, great tenants, even though it's not very diversified. It is a solid portfolio, 99%, 100% rent collection. That is phenomenal. You don't even have to worry about it, it seems like, for any reasonable length of time. So it's a really strong portfolio, and that's not going to sell for cheap unless you're robbing someone, essentially. So I don't think he's getting a great deal on the price here, but it could be part of this sort of larger effort. I don't think Equity Commonwealth and Sam Zell are going to be keeping this portfolio as is. I think they could be using this as an opportunity to sell off the more overpriced properties that might have really strong tenants in there, and the lease isn't going to renew for many years, so you don't even have a chance to bump rents, and that'll be the chance to sell that property at a premium to someone else who wants to get in the industrial space. Maybe that's what they're doing here, since they do have a lot of new tenants that just came on, or new leases that they just signed. You got many that aren't expiring from that graph I saw. Many aren't expiring till 2041, 2035, so many years out. So those might be the first candidates to be sold, since you can get a premium for those tenants. You can't raise the rents anytime soon, but if someone wants a nice stabilized property, you could sell that off. That seems like something that Sam Zell would do. That's something he basically did with the Equity Commonwealth portfolio. Bought a great portfolio of office properties and then started dishing them out, selling them for the next 5 years or so, or 6 or 7 years now, and now he's got this huge cash pile that he's sitting on. And that is something he kept. If this is all he wanted, he would have used the cash. Why use shares if this is all you want is this portfolio? I think this is more of a springboard. They're probably going to liquidate some of the properties, I would think, and then use that to actually go for that big distress deal that he's been talking about trying to find for the last few years now. Because there definitely was a lot of concern on the call that, hey, Sam Zell, this great distressed real estate investor, turns around deals. The grave dancer is his nickname. He's getting into this walk in the park portfolio that you hardly have to do anything to. There's not much you can do to it to really raise a lot of value. Unless Sam Zell's seeing something that we aren't, and he's not really saying what it is, it definitely seems a little bit weird coming from a guy who's built his reputation on turning around distressed deals. But to his credit, Sam Zell is very open-minded when it comes to trying to find good deals. He's not stuck on one sector. Real estate, thankfully, is pretty similar at the very high level across sectors, so doing an office lease isn't going to be too much different than an industrial lease, other than some nuances and some different sort of practices within each sector, but it's generally the same thing. You buy the space, you get it in a decent location, and then you rent it. That's the whole real estate game. It doesn't matter what sector it is. Just what you add on top of that with amenities and different management structure, that's where it really changes. And of course, finding actual tenants in the sales process can be quite a bit different too. But overall, it's a very similar game. He's been around it for many years, so I have faith that he'll definitely do well. I just don't know how much value he can really create with the already super high quality, I don't want to say bulletproof, but definitely very strong portfolio. But the cash hoard is still there, so if there's a distressed deal in the near future, he should be ready to go. Anyways, that was a long one. Just wanted to get in some greater detail on this Equity Commonwealth Monmouth Real Estate merger, since this is very big news from the real estate world. Haven't seen a ton of commercial real estate transactions, frankly, over the last year. The real estate market's been in a sort of suspension. The only one that's really been clicking and moving along has been industrial. So interesting to see that this is the sector that Sam Zell went for. Maybe this is an inflation play. He hasn't said that explicitly, but sitting on this big pile of cash, that's being eroded by inflation, and maybe he just wants to have something to kind of protect the portfolio a little bit, has some steady cash flow coming in so he can start creating value that way. And if then there is inflation, you got the debt value that's going to be eaten away, then the property value should go up as well. But the value of cash is definitely one thing that will suffer at the hands of inflation if we get a huge surge in it. But anyways, if you like this video, found it informative, or got some value from it, then definitely like it, since that would help the channel out a lot. And if you like this sort of content about investing and personal finance, then be sure to subscribe, since I put out new videos every single week and wouldn't want you guys to miss out. And be on the lookout for a collaboration I'll be doing in the near future with Karan Gurnani, talking about this deal, maybe what Sam Zell is really trying to do here, where he's trying to steer the portfolio, his plans to potentially sell off parts of the portfolio that he hasn't made explicit yet. We'll definitely be talking about that, so be on the lookout for that. But until next time, take care.